Today's session is all about asset allocation. A lot of you have must heard this particular term in the investments part, and the idea is we do these sessions to make sure that we simplify things for you and not complicate this. So, asset allocation, by its very nature, when we say the word, in very much layman terms, when we are talking about asset allocation, it is nothing else but basically diversifying or spreading your risk into different asset classes. Asset classes means stocks, bonds, commodities like gold, silver, crude oil, then currencies like euro, pound, dollar, right? So like that, your risk is spread into different asset classes. So tomorrow, if let's say in the future, if gold prices have dropped but stocks are going up, then one leg of your investment is giving you profit while another is in loss. So it kind of creates a balance for your portfolio. Now, the point is at what percentage you should diversify, how much money you put in which asset class is what asset allocation is all about. So if you have, say, $100,000 and you are given these three, four asset classes, that why don't you put some money in gold, something in stocks, something in bonds? So asset allocation means out of that $100,000, how much percentage you're going to put in stocks, how much percentage you're going to put in bonds, or how much percentage you're going to put in commodities, right? So this proportion which you allocate or which you assign to each of this asset class, it depends on a lot of factors, and we are going to discuss about those factors as well, because a lot of investors, they come to me and they ask, um, how should I know that I have to put more money in stocks than bonds? Sometimes the economy phase becomes like that it's pretty evident that stocks are doing fine. So a lot of times investors, they increase their exposure towards stocks. Sometimes they reduce their exposure towards stocks depending on how the market is. But at the end of the day, how can we predict what's going to happen? So that's always riskier, right? So I'll tell you some factors on which you should decide how to allocate your portfolio to these different asset classes. And it definitely has to do with your age, with your risk profile, what sort of phase of life you are in. Are you making enough money? Are you ready to take enough risk? And all of that. And whatever we are going to discuss about, whether it's opportunities or how you allocate your assets to different portfolio, please talk to your risk managers or financial consultants first before you take any decision. This is a session for information purposes only. So I just want to make sure that everybody understands what asset allocation is. And after that, you definitely talk to your risk managers, ask them that, okay, this is my target, this is my investment goal. On the basis of that, what do you suggest? Where should I put money? Right? Now, uh, let's start with the idea. What's the landscape like? Every year, things change. I've seen last 11 years of financial markets, and we have seen a lot of changes happening. Tell me, what was 2020 all about? What affected, and you can use your chat options to write it over here. What impacted stock markets the most in 2020? The answer is pretty obvious, but you will see that as the year goes back, and we'll talk about how every year was a different year within itself for the investors. But until then, tell me what what was one factor or a couple of factors that affected stock markets in 2020? You can use your chat options to write. Right. Okay. Answers coming in already. Perfect. Hmm. Okay. 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 All right. Okay. Perfect. Perfect. So I think everybody understands. And it's really good to see everybody active. So everybody's replying on chats. That's really good because with webinars coming in, the interaction face to face is very less. All you can do is just hear my voice, but it's really good to see you participating. So that's great. So everybody said mostly COVID-19, right? So COVID impacted a lot on the stock market. So we saw the first half of 2020. stock markets dropping in, and then within a month, when they fell down more than 40%, the stock markets started going higher. And a lot of investors, they went through this roller coaster of emotions, because first of all, there was a big virus at large. Everybody was concerned about um, what was going on in the world. And then everybody was very scared. And on the top of it, there were massive job cuts. I'm sure a lot of your friends or in family or acquaintances must have lost their jobs. There were so many layoffs. So 2020 ruled in 2020, COVID ruled for the stock markets. There were ups and downs, and we saw a very different strategy by the investors. A lot of people, they started putting money into technology, Zoom stocks, Amazon, Netflix, all of these stocks. Remote lifestyle became a thing, right? So you see, a lot of money was allocated towards that particular asset class. Now, when we see before 2020, uh, 2018 or 2019, it was all about uh, how US went into a trade war with China, with Donald Trump being the president. And we saw US stock markets reaching new highs during Donald Trump. From 2016 to 2020, or before 2020, before COVID hit, we saw actually golden years for technology stocks. So we saw in 2018, 2019, even there was a trade war between US and China, but stocks continued to go higher. In 2014, we saw China melting down. In 2021, again, we saw Chinese stocks falling down a lot, and that was the result of increasing regulatory pressures. So a lot of technology companies in China, government decided to put a lot of regulatory restrictions to keep a check on them, and companies like Alibaba, companies like Tencent, and a lot of Chinese stocks, they actually came under a lot of pressure. So if you see Alibaba, can anybody tell me the highest Alibaba has reached? Alibaba stock, what is the highest price? You can take a guess, or you can Google it if you want. And I'll tell you what was the lowest Alibaba saw during this entire meltdown in China. What do you think? What was the highest? Yeah, you can take a guess in dollars. Okay, okay. So different numbers coming in. I can see different numbers coming in. Okay. So I think a lot of you have also seen Alibaba personally. Great. So some of you said 100, 150. The exact price Alibaba saw the highest was around 300, $315. So a lot of you said that above 250, above 250. You can see most of the answers are above 200, above 250. One particular person said $300. So the highest it went was 315. And the lowest it came in 2021 was $58. Now, the point is, now at this particular time, it is around $115. But we saw this big fall from 300 to 58. It's impossible to catch the low, right? So what I'm trying to tell you is the economy or the stock markets also go through these different phases. While between 2016 to 2020, technology remained something which was so strong that nobody thought that tech stocks will ever fall. But in 2021, what has actually happened when the world reopened, and one more thing happened in 2020 when COVID came, a lot of central banks, they reduced interest rates to the lowest levels, and they started injecting so much of cash in the economy, because 3 months of lockdown had a lot of impact, and central banks saw it coming that there is going to be a big impact on the economic activity. So global central banks around the world, they slashed down interest rates, they slashed down the lending rates, and made credit cheaper so that more people can borrow, and the economic activity at least gets a cushion because of the lockdown. So when this slashing of interest rates happened and a lot of cash was injected, when in 2021, when markets actually reopened, there was a lot of pent up demand. There was a lot of excess cash along with the consumers, and there was this huge influx of consumption and pent up demand by the businesses, Businesses wanted to get back on the track faster because 3 months of lockdown had impacted a lot of businesses. So when they got the opportunity to reopen and start the production again, there was this massive demand, which was a pent up demand, and that demand increased the prices of so many commodities, which created inflationary pressure on the economy. And that's how 2021 saw the 40 years high inflation. Inflation was at its highest in 40 years in 2021, and central banks were forced to now make credit more expensive, which can reduce down the economic activity, reduce down the consumption from investors, and bring inflation to a target, because high inflation is not a very good factor for the economy. So this is what we saw in 2021, and that continued in 2022, because by the end of 2021 we saw inflation piling up. We saw Chinese stocks going down, not only just because of regulatory pressures, but also a property crisis. One of the largest real estate companies, Evergrande in China, went close to the bankruptcy, and we saw a property crisis in China, and which further led to the downside in Chinese equities. Another thing which happened in 2022 was uh, the COVID in China still continued, and that's why China was very closed, and which created a lot of supply constraints as well, and that also was a problem because demand was high and supply was less because of COVID constraints in China, and that also increased the prices. So overall, entire 2022, China remained in a lockdown with its aim to make COVID zero. But then by the end of 2022, we saw China opening up. We saw already the COVID policies were loosened up, and now China is operating fully functional. And that has also become a sort of threat because there are a lot of Chinese investors who have so much of cash. And same thing would happen in 2022, excess cash and people ready to spend. It fueled the consumption and fueled the prices up. And now, when central banks are trying to control inflation, China is opening once again. It's one of the most important factor every investor should watch, because the interest rates in China have not been increased how US and Europe and UK and other companies did. So we have seen over here that China is expected to still keep the rates same unless higher inflation kicks in. So the lending rates in China are still less, but the consumption category and the savings of the investors is still high. So you see lower rates and high cash, you can expect inflation coming in. So this is going to be very tricky when China gets fully functional and reopens. And this is one of the important things which you should see in 2023 also when we are calculating the risk. Now, coming back to the landscape of what 2023 looks like, there are three areas which you as an investor have to be very careful. Or if you're managing portfolios for someone, you have to be very careful, because everybody is very excited to enter 2023. We make all these resolutions. I always see the first week of January, you cannot go to a gym or to a park because new resolutions, everybody is so fully focused, right? But the most important thing is your health. But also another thing which is really important is your wealth also. So while you are taking care of your personal goals, um, you also have to check, along with your fitness goals, you have to check your financial goals as well. And that is something which you should also put in your resolutions list. Now, three factors, three areas of attention for 2023. And we are looking at seeking downside mitigation as the equity bond correlation remains unstable, planning for cyclical uncertainty and macro volatility, looking through the volatility, how should portfolios evolve for the long term. So just to understand, we'll take the first point, seeking downside mitigation as the equity bond correlation remains stable. Now, we have to understand a few things. Over the last few decades, there has been a sort of negative correlation, right? Which means we used to see stocks performing well, bonds used to come down. When bonds were performing well, equities used to come down. So it provided a very good balance to many allocations, because you know that there are stocks and bonds, and you allocate it in such a way that if stocks perform well, and your allocation is more in stocks, you still end up making a net profit, right? But last year, this negative correlation, it became actually positive. And when I say it became positive, that means what happened was we saw stocks also coming down, and we saw bonds also coming down. So both these markets declined, and this positive correlation now has turned this stocks and bond relationship uh, from risk mitigating to risk additive. Earlier, stocks and bonds was a risk mitigating portfolio, but now stocks and bonds together has become more riskier, right? So this is something which we have to understand, because markets, they assumed, because how past 10 years have been, or 20 years have been, markets sort of assume that central banks will always respond in a similar way. If macro conditions, if the economy is not performing well, or if there is a recession risk, then central bank will come to the rescue, cut interest rates, right, and do whatever it takes to bring economy better, right, to make economy better. Now, because this used to happen, this helped for the longest time and maintained the negative correlation, right? Because a struggling economy is negative for stocks, but then positive for duration, because if rates are lower, we see bond prices going higher, right? But now central banks are in a very difficult dilemma, because now central banks are facing this high inflation, right? And the choices become really, really difficult, because they cannot loosen up the monetary policy, right? If the economic outlook is gloomy, or if it looks like recessionary conditions might come, they cannot loosen up monetary policy because inflation is already high. So now, if the economic outlook worsens, they still have to increase interest rates. Now they have to control inflation. So bonds are also struggling in this environment. In fact, 2022 was one of the worst years for the bond prices. We saw bonds falling down because central bank continued to increase rates, and now the rates have become around 4.5%. Target is around 5%. Depends on how the first half is going to be. So at this particular time, it still remains a challenge for central banks and governments, that how this economic growth and inflation trade-off will work out. Bonds and portfolio, they still play a very, very important role, because these are fixed income products. When you buy a bond, you buy it for a specific time period, and when the bond matures, you get your money back, along with a certain interest payment, or a what is called coupon, which comes across every year. So bonds in anybody's portfolio still has the potential to give a fixed income, right? You can always sell your bonds, or you can hold on to it for a longer period of time. But if you're buying a US government bond, it kind of becomes a relatively less riskier as compared to the stock. So a lot of investors still allocate bonds to their portfolios, right? Of course, we are going to discuss what factors impact the asset allocation. But then, discussing this first point about how the investors are seeking a downside mitigation, because this now, at this particular point, this equity bond correlation has become very unstable since in 2022. Both the markets have come down. Now we have to take new ideas, because there are already investors who are trying to do that. And sometimes when you're doing your asset allocation, you have to understand you have to go defensive in equities. And when I say defensive in equities, I'm saying you pick those quality stocks while you're allocating money in stocks from your portfolio. Try to pick defensive stocks. Defensive sector is not related to arms and ammunition. Defensive sector means those sectors in stocks, or those companies which are deemed to be called recession proof, which means whether economy goes down, but those kind of stocks still remain stable. They don't uh, move much. Like how, if you see Tesla, for example, Tesla has gone down from where it was, and a lot of investors, they lost money in Tesla. A few investors are still holding on, but Tesla is not a defensive sector. But on the other side, if you see companies like Coca-Cola, or companies like Johnson Johnson, Procter and Gamble, for example. These kind of companies, they fall into defensive category, right? So there are a lot of investors, they try to consider ways to use their risk-seeking allocations, because what happens is you have your bonds, you have fixed income, right? But at this point of time, a lot of investors, we see that they have started again looking towards defensive stocks, and that is what they call value-based investment, because a lot of value stocks have done well in 2022. And what are value stocks? Value stocks are these companies which are less volatile, they move less, and they give you a fixed dividend also. And at this particular time, when we see there are there are talks of coming recession in US, in UK, in Europe, then there is a Russia-Ukraine war situation which is already coming in. It may not be the worst idea to allocate some of your funds towards defensive equities, be away from the adventure. And I will talk about specific sector outlook also, and I'll tell you which sector and which subsector you can more focus on, because a lot of times investors, they have this stereotypical view that, okay, if interest rates are high, then I should not be investing into technology stocks, because when interest rates are high, tech stocks are the first to come down, and that happens. But within technology, there are a lot of subsectors. I'm talking about companies which are technology companies, but subsector wise, they belong to something called as software as a service. I'm sure there are a lot of people who have heard about the term CRM. A lot of companies use CRM to manage data efficiently. And when I say data, I'm talking about leads and customers. Data is the new gold, right? So every company who has enormous amount of data needs to protect and make sure that it is used efficiently. Every company I know, or every company we see, use CRM. So that particular segment is called software as a service. So there are some stocks in that particular sector which you are looking from a very long term perspective, and these are companies which you should always keep into your portfolio. But as I said again, you look at your risk appetite, you look, talk to your financial consultants, and only then take a step. But as we go forward and we talk about how to allocate stocks and bonds together within equities, look for something which is more on the defensive part. And then another thing which you have to see while you try to mitigate the risk is have active control over your portfolio. Use options, use pair trade strategies to protect your portfolio. Right now, you have to be slightly more active than you were, because passive, as of now, may be a good idea for somebody who does not have enough time. But then, even for those people who don't have enough time, you have to be more actively involved in your investments, because there are a lot of pair trading strategies, and we'll do a section sometime on how pair trading works. But basically, it involves buying one segment and short selling another, and trying to mitigate or earn a net profit over the movement. So sometimes it happens between two commodities like Brent oil and WTI, when there is a difference in their prices. When it becomes too long, you buy one, you short sell another. Sometimes these kind of pair trades can also happen between two kinds of bonds, or let's say US bond and European bond, depending on what the interest rates is going to be like. Like for example, if US bonds, if US central bank is expected to increase interest rates, then it might create a fall in the bond prices. So you short sell. And if European bank is willing to not increase the rates, then the bond prices still continue to go up. So for example, you can short sell US and buy European bonds. Again, this is a very hypothetical situation. At this point, as we speak, even Europe is talking about increasing the interest rate. So that might again bring a decline in the bond prices. But to give you an example, these kind of pair trades where you buy one and short sell another, these can be easily executed in any of the trading and investment platforms. and you can talk to your risk consultants about it. So this is how you seek a mitigation of risk when you see that this equity and bond portfolio is not stable. You have to be more actively involved when you're picking your stocks. You have to be more inclined towards defensive sector. Second, you have to be more actively involved. You can use option-based trading strategies. Talk to your consultants. You can use buy call options and buy put options, and you can create all these strategies if you see that your portfolio is under pressure, right? Second thing is planning for cyclical uncertainty and macro volatility. So that is something which I'm sure every investor always thinks about this, because uncertainty is something which comes across, and there is a lot of volatility also. Because if we see now the new economic reality, what we are in, the central banks now, they cannot focus only on maintaining stable growth, right? Because at the end of the day, inflation kicks in and all these plans change. So there is a lot of cyclical divergence, and I'll explain you more about this. Because what happens is there is a lot of fluctuations and there is a lot of volatility, and this is expected to increase in currencies, in interest rates, and taking decisions. Because now every country has a different phase. Every central bank tries a different phase, and these moves and these phases are very frequent, right? Sometimes, let's say, for example, US central bank says that we are going to increase rates to 6% or 5%, while European central bank is not in a condition to do that, so they continue to keep the rates safe. So there is a divergence, there is a lot of difference between both the central banks, and this uncertainty has created a lot of volatility also. So you as an investor now have to take advantage of this volatility, right? Because now we are expecting this increased volatility and this economic divergence which is happening, where US is going somewhere else, Europe is going somewhere else. uh, this is going to contribute to a greater asset price differentiation. If you see in currencies, dollar became really stronger, Japanese yen got really weak, INR got really weak, uh, GBP, Great Britain pound, also gone weak. If you see Swiss franc, it became more stronger, appreciated. So now at this point of time, you have to be more actively involved and see which areas are good to enter. If Europe is keeping the interest rate same, then probably you can buy European bonds if you're expecting an increase in the bond prices. If US central bank is expected to increase interest rates, then wait once the rates are up, bond prices have come down, and then you enter. When interest rates have peaked out, when they are not going to increase rates further, only then enter and buy bonds. And I'm talking about buying bonds of shorter to medium term duration, not very long term, because there's a reason behind it. Central bank rates have gone too high, at least to 4.5%. And as per the last inflation data, the inflation is around 6.5%. So over a period of year, if inflation gets under control and central bank decides to halt the interest rates, not be enough to bring economy to the same level, because rates will still be high. 5% rate is still high, right? So Fed might have to choose 2024, the year where they will start cutting rates down. Now when that happens, again your portfolio becomes vulnerable to the liquidity, to the volatility. So if you have bought 30 years or 10 years or 20 years maturity bonds, they will be very vulnerable to the interest rates. So you try short to medium term bonds, and I'm talking about bonds 3 to 5 years max. 3 to 5 years is something which will not be impacted much as compared to the long term bonds, right? So when you're looking at the bonds, also try short to medium term duration, and that is something which you should be looking at from the allocation point of view, and plan the volatility accordingly, right? Also, when we are looking at, since we are talking about volatility, one thing which you also have to check apart from taking advantage, uh, as I said, be more actively involved, right? And there is something called thematic investing, right? And thematic investing is a term which has been going on for the longest time now. But a lot of investors, they are very resistant to it. Probably they know less about it, or again, it's one of those areas which is very futuristic, because thematic allocations, or putting money into thematic investing, I'm talking about themes like artificial intelligence, I'm talking about themes like blockchain, not cryptocurrency, but blockchain as a technology. There are a lot of companies which are using blockchain. So thematic investing also can be something which can be a good idea while you're allocating your funds, right? Now, third point which we wanted to speak about, looking through this volatility, right? Because at the end of the day, we have to look through the volatility, how the portfolio should evolve for the longer term. And we have to see this because there are a lot of factors over here. Like when we see in a more volatile regime, when we see the risk levels of tech companies and then defensive companies, as we said, um, the risk is very, it's not very stable, right? So what happens is the investors who have allocated money to the defensive sectors, uh, they try to balance it further by putting more money into defense, right? Taking money out of the technology, putting more money into defense. And again, the point is you're expecting a lot more volatility, and you have to do a thorough research. So important part is how you look through this volatility, how your portfolio should evolve for the long term. Most important part is that your research should be very thorough. Look from a bottom up perspective, right? Be very active with your portfolio. Look first of all which sector is doing well within this sector, which are the bunch of companies within this company, which company is good, which economy is good, and that's how you grow your portfolio. But your research needs to be very strong, because at this time, there is something called margin resilience. And margin resilience, what does it mean? And many investors have been, many analysts have been using this term. But what margin resilience actually means is that in a high inflation environment, there are some companies which can easily pass on the increased cost to the consumers and maintain their profit margins. And then there are companies who are not able to do that. They are not able to pass that cost to the consumers, so they reduce their profit margin. So you have to be allocating money towards those companies which are marginally more resilient. They have better pricing and they can pass on the high inflation cost to the consumers rather taking a hit on their profit margin, right? Because if you're investing into a business, the most important thing you need for your stock is to grow higher, and that will only grow higher if the profit margins are intact or only increasing, right? So when you are maintaining your portfolio, you have to do proper research, you have to consider every factor. Inflation based strategies are very important, because inflation is not going to end this year. It will remain higher compared to how it has been in last year. And we are talking about the next decade. We are talking about another 10 years, right? So your portfolio has to have inflation resilience into this. So you have to understand that inflation is not going to go away, and it's not going to just happen like this. Next 5 to 10 years, you have to build your portfolio keeping inflation in mind, right? So you have to put all those sort of strategies into it. You have to see whether should I put commodities, because commodities is one thing. If the supply is not up to the mark, then the prices of commodities go up. Gold is, if you have seen, gold prices have been going up. So you have to ask yourself this question, that does investing in commodities or allocating money in commodities, is it going to manage the inflation, right? Is it more positively structural to put money in the commodities, gold or oil or silver or like that? Similarly, look for those companies which are, so when we are looking at trends, we should look at trends which are more innovative, right? And there are a lot of trends which are now coming in. Talk about disruption in the global economy, right? For example, if you see, there are a lot, again, that there have been a lot of financial products which have come out, but we cannot deny the fact. In fact, we are having this session, web to web, how digitalization has changed the world, right? So in the wake of pandemic, there has been a rapid progress towards digitalization. consumers have accepted the technology, right? Earlier, if I would do a webinar before pandemic, people would not come. So I had to do a lot of physical seminars. But now webinars, people know the technology, they want to come across and they want to spend time, right? I have at least more than 50 people joining today. And that shows that at evening, you are ready to join because now you know the technology. So there are sectors about electric vehicles. We are talking about autonomous driving. We are talking about agricultural innovation. So your portfolio should have all of those things. So, and guys, what I'm saying is your allocation now is much more broader than it used to be. So you are not restricted to a point where you just have to put money in stocks and bonds. Of course, that is the bigger area. But now commodities have also become a part of it because it's a high inflationary pressure we are forcing, we are feeling. And for the next 10 years, we'll see this inflation. So our portfolio building has to be completely different than what we have seen so far, right? So look into innovative trends, look into innovative and secular trends, and most importantly, as I said, do thorough research, take help of your financial consultants, see if you can involve some commodities and create inflationary based strategies. If you're buying bonds, can you put treasury inflation protected bonds also, which are called tips, basically, right? So that is something, that's how allocators landscape looks like for 2023. Moving on, which are these factors that affect your asset allocation? Now, this is something which is really, really important because what I just said is what I feel at my particular age with my particular goals. But then for your end, whether you have to invest in equities more or bonds more or gold or oil more, you have to see from these particular factors, because your age, first of all, is one of the biggest factors that can influence your asset allocation. How much money you're going to put into stocks? Stocks is more riskier than bonds. How old are you? Have you started investing at a young age, or you're about to retire right away, right? So you have to look into your age. As your age increases, as you inch closer to the retirement, the composition of your portfolio, you should be more inclined towards bonds rather than stocks. If you're not working anymore, you expect a certain sort of lifestyle and you do not want too much adventure in your portfolio, reduce down your exposure in stocks, increase it in bonds, and that's how it works out. Then again, we are talking about something called as time horizon and your financial goals, because that is also something really, really important, right? Time horizon. When do you need this money? Because you can have your short-term financial goals, and I'm talking about short-term. A lot of you ask what is short-term. In short-term can be 3 years, right? We're talking about a short-term financial goal, and some of these can actually include, for example, you need an emergency fund or life insurance for family or health insurance for your family, and all of these goals again, short term, they can be medium term. If you have to purchase a car, you have to build some money to buy a home or a down payment, right? You're planning a vacation. Then there are your long term goals, right? Long term goals is about your child's education. You're planning your wedding. Anything, you have to consider your goals. If your goal is to save your money for your child's education, you cannot start putting your money into cryptocurrencies, right? That's not the right thing to do. If you want a certain fixed income to pay your loans for your house, you can probably invest into bonds, which gives you a certain amount of interest. So that interest can be used to pay interest for the loan which you have taken. So that way, you have to consider your goals. Classification of goals into short, medium, and long term, it really impacts how you're going to allocate your money, right? So that is something which you should definitely see within. And making goals is not enough. You have to see how close you are to achieve your financial goals, right? Do you need a certain, there are income tax benefits also which one wants to receive. So your time horizon, your financial goals, how, when do you need the money, how your financial goals are, what are your financial goals, that is something also which is definitely going to affect your asset allocation. Another thing, the next three factors, we are talking about number of dependents, right? If if you are the only earning member in your family, that is something which is really, really crucial. You have to see whether where do you stand, how many dependents you have. If something happens to that money, what happens to them, right? So there are a lot of such things which you should definitely keep a check on. If I have 5 or 6 members who are dependent on me, can how much risk I can take with that money, right? Similarly, risk profile. If you are an aggressive investor, if you are a balanced investor, if you are a very cautious, if you're very conservative. So if you're very conservative, then basically you're not willing to take higher risk, right? So you're okay with low returns because you don't want to take higher risk, so you will invest into bond funds or something which has much capital protection or relatively less risky or almost zero risk. I will never say zero risk because that's not such a thing, zero risk, but I will say almost zero risk is for a conservative investor. But if you're an aggressive investor, then you put your more money into stocks rather than bonds, right? You're trying to beat inflation, you're trying to earn an income. So you have to classify yourself into aggressive risk appetite or a moderate risk appetite or a conservative, and then you have to see your financial goals. You have to see how stable your income is. If if you have a business which, because what 2020 taught us, everybody should have an emergency fund. If you don't have that fund, you should start building right away, because income stability, what 2020 taught us, the best of us lost the jobs, the best of the businesses got shut down. So definitely you have to understand now this, that every income is not stable. It doesn't matter what you feel inside, how secure you feel your job is, but at the end of the day, something like pandemic will always hit, and you will be caught off guard. So start building that emergency fund right away, and because that is going to decide that how you have to allocate your money and where you have to allocate your money. Now, moving on, will the table turns for a 60-40 portfolio this year? What is a 60-40? And you can also see a chart over here which shows in 2022, as I told you in the beginning, it has been a bad year for stocks and bonds both. We saw bonds going down by 15%, and we saw stocks going down by 18%. So if your portfolio was 60-40, which means 60% was into stocks and 40% was into bonds in 2022, you would have still lost 17% in your portfolio. But as you see, how diversification reduces down your risk, because if, let's say, you have put money only into stocks, you would be down by 18%. If you had put money only into bonds, you would still be down by 15.5%. A 60-40 portfolio, you still lost 17%. But so that's the thing. What's going to be for this particular year? Because, and this is a very, very classic strategies, guys. 60-40 is a very classic allocation, because by holding 60% of your portfolio in stocks, 40% in bonds, the thinking goes that you get the best of both worlds, right? Because as I said, the correlation between this was always negative. One used to do better, another used to come down. And you get the best of both worlds, high growth potential, right? Stocks have a higher growth potential but higher risk. At the same time, bonds are more conservative, it protects you, right? So now what we saw through 2022, uh, because of this correlation became positive, and we saw US stocks, bonds both went down, a typical investor would have lost 17%. Now this 60-40 composition is in trouble, right? Because this was designed by the investors, or how it was designed was for moderate risk and moderate return, right? And this was based on the assumption that while stock market periodically goes down and bond market periodically goes down, they will not go down at the same time, because this is a phenomenon which, it's very rare. But then, and from last 20 years, the stock bond correlation, it has been consistently negative, and investors have largely been able to rely on the 60-40 thing. But this, as I said, 2022, a high inflation, Federal Reserve increased interest rates, largest 6 month increase to interest rates in 41 years. And that's where we saw this entire negative correlation becoming positive, right? Now, the thing is, this stock and bond returns, we have to understand this. First of all, stock returns on both indexes, they stay negative. This is going to be the first year that stocks and bonds both have a negative return. This has not happened since 1969. And if the current return holds, this would be about 3 times worse, right? So we have to understand, we have to stick to a plan. And at this point of time, because 60/40 model is so common among people, your basic analysts are going to tell you this thing. And this is so basic, and this is especially for those people who are within 5 to 10 years of retirement, right? Who have started taking withdrawals from their retirement accounts. So this is 60/40 model is very common among those people. But if you're not in that camp, if you're not into that camp, if you're not those people who are taking money already, withdrawing money from your retirement accounts, or who still have some time, and who you're still working, it may still make some sense to make some tweaks to your strategy, right? Since this whole turbulence could be on the horizon, because if Fed continues to hike rates, you still will see that bond prices coming down, and stock prices also might get impacted. So this is where we have to see the composition has to be handled in a way. If you are becoming very aggressive, 70% of portfolio can go to stocks, 25% could go in bonds, and then 5% can be just cash put into fixed deposits or something, right? uh, Cash which you have in your portfolio should be accessible. And number one thing is to remember that you don't have to overreact to short-term fluctuations in your portfolio, because we every time we remind this to the investors, um, because this is something, it's not going to stay the same for too long. Yes, inflation might stay for too long, but at the end of the day, markets will turn around. So for those people who are very close to the requirement, the retirement, 60/40 might still make sense for you. But then those who are going towards a moderate or an aggressive risk appetite probably can increase composition of stocks versus bonds, because a lot of stocks have come down, will understand the sectoral growth of how every sector is expected to perform this year. Definitely could keep bonds in your portfolio, but within bonds, try if you can put municipal bonds, because next we'll talk about, are municipal bonds worth a look during the rate hikes. And what is a municipal bond? Uh, it's a fixed income bond, right? It's issued by a government, municipality, township. It basically, municipal bonds have this advantage: they're tax exempted. So the returns of such bonds, they are not subject to any taxes, and it becomes highly attractive investments for individuals, right? Who comes into a very high tax bracket from a US perspective. But then at the end of the day, there are a lot of municipal bonds which actually became really, really key factor for a lot of investors, because this is a well established behavior in the bond market. Whenever central bank raises the interest rates, you can always expect better yields for fixed income investors, right? But then anybody who's looking for capital gains, which means anybody who just purchased bonds so that bond price will go up and they will sell it and make profit, for them the returns are lower. But anybody who's expecting better yields, those income investors still get a higher income, right? But not the capital gain when central bank increases the rates. Now the coming rate hikes, when we see if rate hikes happen more, uh, because bond prices are expected to come down. As of now, it will be an ideal situation to wait before you invest into the bonds, because if central bank do more rate hikes, we'll see bond prices falling down, right? Once it stabilizes or potentially falling, at that particular time, it will be a good idea to buy bonds, because when Fed will reach to a point where they say, okay, we're not going to increase any rates, and next year when they start cutting down, that's where we'll see bond prices going higher. So for those capital gain investors, do not invest in bonds right now, because unless it's a municipal bond, because municipal bonds, they don't follow this pattern. Uh, History suggests that Fed rates may not be such a bad news for municipal portfolios, because if we see last 4 cycles when central bank increased the rates and tightened up the monetary policy, the municipal bond yields were not as sensitive to a higher interest rate, right? A lot of investors, they might have thought this, but they were not very sensitive. And in fact, when we are talking about short-term municipal bonds, they are still more sensitive to the central bank rates. But then overall, if you see last four rate hikes, municipal bond yields, they change far less than a corporate bond or the overall rate, right? So most cases, the average yield of a municipal bonds changes by less than a half the rate of the prevailing interest rates. So returns on both municipal and corporate bonds mostly remain positive. In fact, if you see between 2006 and 2018 rate hikes, municipal bonds returns were significantly higher than corporate bonds. Now, when you buy a corporate bond, you are taking additional risk because you're talking about companies. But when you buy municipal bonds, you are referring still to the government, right? Now, again, what I'm telling you doesn't mean that you put all your money into this particular sector of the market, right? Because what has happened in the past doesn't mean that the future will have the same thing. But what it means is that for municipal bond investors, the rate hikes may not be a reason to change your investment strategy, right? So when you're looking to invest into bonds also in a high interest rate environment, and you prefer bonds, look into the municipal bonds. There are a lot of municipal bonds available, even with our platforms. If you talk to your relationship managers, those people who have invited you for this webinar, you talk to them and they will give you a list of these municipal bonds which you can add in your portfolio, especially during a high interest rate environment. And then again, as I said, a sector outlook. So what I was talking about, while you're looking at every has been a defensive sector. When I say defensive, that means when recession kicks in, investors, they prefer to invest money in consumer staples and healthcare and utility because these are much more protective areas. They get away from technology, they get away from a lot of media and entertainment. Now, healthcare has been very defensive, but then again, within healthcare, there are some subsectors you can look into because what happens is, I hope everybody there is a unstable network. If you can hear me properly, please just write a yes or a okay, so I can continue with the session. Okay, a lot of you. Okay, perfect. Everybody can hear. So within healthcare, uh, focus on healthcare equipment companies. And what are these healthcare equipment companies? These are medical equipment making companies. There are a lot of companies which create these new medical equipments, new medical technology, right? Now, within healthcare, you should be focusing on that subsector of companies. Those companies like Boston Scientific, these are healthcare equipment companies, and not just US. In fact, focus more on emerging markets, those countries which have aging population, those countries which are looking probably from a healthcare point of view need more and more advanced technology. So there are a lot of emerging markets. Within emerging markets, look into healthcare sector. Within healthcare sector, look into medical equipment companies, right? Especially those countries which have a higher aging population where healthcare is much more needed. There are a lot of countries which are still looking for mRNA vaccines, and there are a lot of companies which are making that. So specifically, be very careful about it. Within healthcare, you should choose the right subsector. For example, if I say Novavax, it's a healthcare company, but if the demand for Novavax vaccines now have reduced, right? So instead of investing in Novavax, you can probably look a company in an emerging market, which which basically creates healthcare equipments or medical equipments in that particular area. Similarly, in energy, 2022 was very challenging for oil, but 2023, if there is a recession across different economies, there could be a slowdown in the global growth. Oil production can reduce, but what you have to see within energy also, do not invest much into oil producing companies, but then look for those companies within energy which after the oil is produced, provide equipments for refining and extracting crude oil, right? Because if oil is produced much or less, that's one thing. but those companies are still better to invest as compared to the oil production and exploration companies, right? Those companies which manufactures machines and equipments that are used to refine crude oil, check that particular segment, right? So when you are allocating money to stocks and different sectors, within sectors, do thorough research for subsectors. Your financial consultants, your risk managers, like the bunch of people we have, the team which we have, also can do that for you. And that's the key when you are allocating your stocks. Communication, for example, there are a lot, like communication has been the worst performing sector in 2022, right? uh, and if there is a global slowdown, we might see less advertising revenues coming in. But within communication, there are a lot of telecom companies which gives you a very good dividend yield. And because of the falling down in 2022, now the valuations are very cheap, so you can still look within communication, look into some telecom companies which are cheaper and give you a very attractive dividend yield. Consumer discretionary, the luxury segment, believe it or not, the luxury segment actually has the capacity to pass on to the rising inflation cost to the consumers and protect their profit margins. So, in a high inflation environment, it may not be the worst idea to invest into luxury stocks. Then there is consumer staples, there is financials, industrials. Industrials, again, uh, because a slowdown is expected in the first half, so industrial may not be a good idea. But again, within, and I'm talking about the manufacturing companies, may not be a good idea. But if Russia-Ukraine war escalates, then so, so do not invest into manufacturing, but look towards more into aerospace and defensive part within industrials. Because if the Russia-Ukraine war escalates, there could be more activity in the defensive. And when I say this time, when I say defensive, that means arms and ammunitions or aerospace sector. Consumer staples are basically the areas which the necessities. And a lot of these stocks, they have performed better as compared to tech, but the valuations have become slightly expensive for these companies. So you prefer utilities over it. Utilities means electricity, power, coal companies, and a lot of pensioners, they invest into these kind of utility stocks because they provide you a fixed income of dividend yield, plus they are low volatile. But again, now times have changed. Within utility companies, you have to consider what happens if there is a rapid transition by government from non-renewables to renewable sources. Coal power companies or electricity companies, they might get impacted if there is a transition from non-renewables to renewables. So be very, very open to accept the fact that when you're investing into utilities, a part of that money should also be invested into solar energy based companies or renewables also, or something what they call it as ESG based investments, right? IT, within IT, as I said, if you want to be away from your Netflixes and Teslas, you can still be more connected towards stocks like Salesforce, for example, which is software as a service, cloud computing based companies, cyber security based companies. And that is also something which is, again, going to be there for another 3, 4, 5 years. This trend will continue to develop. Then we say materials. Uh, One sector which is likely to contract in this particular year is materials. So be very, very careful. Do not invest much into the material sector. Then, from a regional outlook, if we see, US is in better condition than Eurozone and UK at this point. But what you really have to see is the Swiss index, which has been very defensive. And the Swiss index, 60% of the index is made of companies which are basically healthcare and consumer staples. So the volatility is less, right? Another area which you should definitely keep a check is Middle East, because now Middle East is becoming, the Middle East has actually outperformed a lot of global markets in 2022. UAE, in fact, is becoming very open to attract foreign investors to have foreign ownerships. They're doing international roadshows in US only to bring more and more foreign direct investment. So be open to invest into Middle Eastern companies as well. Within Asia, look towards more emerging markets like India, for example. There's a lot of FDI in India, there are a lot of foreign investors in India, and they have not withdrawn 70% of investments have remained in India for the year of 2022. Plus, there is a lot of volumes coming in from the youngsters. So, India is also one of the most important emerging market you can look into. And with the new budget coming in, few themes which you can see for this year: inflation, keep a check. Dollar has been very strong, but there is a possibility if interest rates stop increasing, then dollar might, that supremacy of dollar might peak out. It may not fall too much, but then it might stop going higher also. Uh, as I said, China is again looking forward for a reopening, so we have to see China risk also. If there is too much consumption, it might increase inflation. And again, as I said, the mortgage rates in China are still very low, and there is excess cash among the Chinese investors, so that divergence can bring more and more inflation. So you have to be very careful about that. But do look into the Chinese stocks, guys. Consult with the risk managers which Chinese stock is good, because it's still very risky. But then these stock prices have fallen down a lot. Something like Alibaba from $300 has gone down all the way to 58, and now it is 115. So like this, there are a lot of such companies. And then last but not the least, you have to be taking care of, be very updated about what's going on with Russia, Ukraine, because as of now, a lot of investors are away from European equities. And the reason is there is expected to be a high energy crisis in Europe. Winters are coming, and it's going to be more and more crucial because it's going to be excruciating winters in Europe. They might need more and more natural gas, and the Nord Stream pipeline has already been banned by Russia. And Europe relies more on Russian gas as compared to US. So at this point, Europe is under a lot of pressure. You have to see how Russia-Ukraine war turns out, and that will decide how European equities turn out. Again, one last thing which I would want to say: semiconductors. Last year or before that, we saw there was a shortage of semiconductors. Do not deviate away from semiconductors, whether there's a shortage or not. There are a lot of semiconductor companies. In fact, if you know about Taiwan Semiconductor Manufacturing Company (TSMC), which brings 90% of the semiconductors, produces 90% of the semiconductors, and semiconductors from using our phone to our laptop to every single device in our office, it requires semiconductors. You're talking about digital transformation, you're talking about metaverse, you're talking about cloud computing, you're talking about digital payments, you're talking about self-driving or autonomous driving, 5G, cybersecurity, remote lifestyle, machine learning, artificial intelligence. Semiconductors are a core component across all of these segments. So be open to invest into semiconductor companies as well. Talk to your risk managers, pick some of those and put into your portfolio. But as I said, do a proper risk and reward for yourself. See where do you stand vis-a-vis taking risks also. So 2023 could be an opportunity to position the portfolio for the longer term. All these factors I said, especially in the field of technology, we are talking about a further long-term perspective, whether it is cloud computing or cybersecurity or digital payments, or we are talking about semiconductors, for example. But that should be a part of your long-term portfolio, right? Okay, thank you so much for the session. There are a few questions over here I would like to answer. Okay, just 1 second. So there's a question. A lot of investors have started their investments at the beginning of the new year. What is the outlook of 2023 equity, debt, and commodities? I think it's based with the Indian markets. Okay, so see, 2023 was a great reminder. 2022 basically was a great reminder why investors should have an asset allocation in place, right? And not to only two, but then at least three asset classes, not just stocks and bonds, but commodities also. Because equity underperformed, bonds were struggling, but gold prices went up, right? Two asset classes are not enough for diversification, is what we have learned this year. Multi asset allocation fund would have done much better than just an equity bond portfolio in 2022. So we are looking at a revival. That there is a lot of, especially in Indian markets, we see that government is pushing the growth now, right? Indian markets are mostly in the growth phase, And overall, for 2023, at least Indian equities look very promising this year. But again, you have to allocate it in the same way. If you look at the banks, for example, deposit growth is lacking. I think it's basically lagging than the credit growth, right? RBI is going to ensure that there is enough liquidity in the system. From bond market perspective, I think much of the rate hikes, they are behind us. And I'm talking about Indian economies only because the question is directed towards it. There will be some uncertainty going down because RBI will want the inflation to come down to a lower level. So some rate hikes cannot be ruled out. It will still happen. I'm talking about 3-year duration bond funds, still better in this situation, right? So same thing, what I talked about, short-term duration bonds, I think that should be good for Indian markets as well. So that is something, again, net, we are looking at gold, bonds, equities. That should be a promising way in 2023. And again, that is something which you should, from an Indian perspective, as somebody asked, that should be the idea. Right. So unless, what are your views on tech stocks? Tech stocks, as I said, focus on those companies like software as a service, for example, right? Those companies which are much more into cloud computing, into Internet of Things, 5G, basically something for another 3-4 years, a longer term perspective will make more sense. Are you available for a one-on-one session? Definitely. All you have to do is talk to your relationship managers who have invited you for the webinar. And I'm definitely available for a one-on-one session. And if you want to have a one-on-one session with a risk consultant, also we have available risk consultants. They can help you out in building a portfolio, whatever sort of product you are interested in, or if you want to take an opinion, we are more than happy to fix up a one-on-one meeting and definitely assist you with that. Right, perfect. So I think these are all the questions. And once again, friends, thank you so much. Since this year has started, I'm sure a lot of you must be doing a lot of rebalancing in your portfolios and talking about where to invest. One thing which you have to consider and definitely understand, keep your money invested, because in a high inflationary environment, worst thing you can do is sit on cash. So you have to allocate some funds to stocks and bonds, and depending, as I said, there are different factors you have to analyze before you allocate your portfolios, or talk to your risk managers and they will do a proper questionnaire for you that where do you stand vis-a-vis allocation. So do that and remain invested. Do not get panicked. This 2022 was a tough year for all of us, but so was 2020, so was 2021, and 2023 is not going to be any different. So you have to be more actively involved, invest more, but then try to stick to quality names, less leverage, put your stop losses if you're a trader, do not take very high leverage, and talk to your risk consultant as well. So thank you so much. We'll be meeting you next week with a different topic. My name is Yogesh. You have a good night, and I'll see you again next week with a different topic.